Hello, my name is Mayanka. I am accounts and finance trainer from Uplatz. Today we are covering the topic of IND AS 104 insurance contract. IND AS 104 insurance contracts. In this topic we will cover all the relevant points of IND AS 105. First point is objective. The objective of IND AS 105. Why IND AS 105 introduced and what is the objective of the IND AS 104 insurance contracts? The objective of IND AS 104 is to specify the financial reporting for the insurance contracts by any entity that issue such contracts. The main objective of the IND AS 104 is to specify the financial reporting. Specify the financial reporting for the insurance contracts by an entity that issues such contracts. Is that the provision of IND AS 104 shall be applicable for the an issuer, and this IND AS specify the accounting reporting for the insurance contracts which are issued by the insurer. In this case, this IND AS required as per the IND AS 104. Such IND AS requires number one, the limited improvement to the accounting by the insurer for the insurance contract. Is that this IND AS require the limited improvement to the accounting by the insurer for the insurance contract, and this IND AS also require the disclosure that identify and explain the amount in an insurer financial statement, the amount which is arising from the and insurance contract, and on the basis of these information, the user of the financial statement can understand the nature, amount, timing, and the uncertainty of the future cash flows from the insurance contract. Is that the main objective of the IND AS 104 to provide the and to maintain the financial reporting for the insurer who issue the insurance contracts. In this case, this IND AS require the limited improvement of the accounting by the insurer for the insurance contract, and this IND AS also require the disclosure that identify and explain the amount in the insurer financial statement, the amount which is arising from the insurance contract, and which helps the user of the financial statement to understand the nature, amounts, timing, and the uncertainty of the future cash flows from such insurance contracts. Scope. Now we will discuss the scope of the IND AS 104. Is that now we will discuss the applicability and the non-applicability of IND AS 104. Is that when IND AS 104 will be applicable and when IND AS 4 insurance contract will not be applicable. An entity shall apply this standard to. Is that IND AS 104 shall be applicable to the number one, insurance contract, including reinsurance contract, that is issues and reinsurance contract that is hold. Is that the IND AS 104 shall be applicable to the insurance contracts that is issues and reinsurance contract that is holds. And IND AS 104 also applicable in the case of financial instrument. IND AS 104 also applicable in the case of financial instrument that is issues with the that is issue with the discretionary participation feature. IND AS 107 financial instrument disclosure require the disclosure about the financial instruments, including financial instrument that contain such features. Is that the provision of the IND AS 104 shall be applicable on the insurance contract, which include the reinsurance contract, and it is also applicable on the financial institutions. The financial institution that contain such features, that contains all these features which are explained in IND AS 107. And this standard does not address other aspects of accounting by the issuer, such as accounting for the financial assets which is held by the issuer and the financial liabilities which are issued by the issuer. Is that this IND AS does not applicable or does not address other aspect of accounting for the issuer. This IND AS is not address any other aspect of accounting by issuer, such as accounting for the financial assets which is held by the issuer or any financial liabilities that are issued by the issuer. Then it is applicable on insurance contract and reinsurance contract, and it is also applicable on financial institutions, but it does not applicable in case it does not applicable on the other aspect of the accounting by the issuer, such as accounting for financial assets or accounting for financial liabilities. And this IND AS shall not be applicable to, is that the provision of IND AS 104 shall not be applicable to the number one, product warranty which is issued directly by the manufacturer. Is that the provision of the IND AS shall not be applicable to the number one, the product warranty which is issued by directly a manufacturer, dealer, or a retailer. When there is any product warranty which is issued directly by the manufacturer, dealer, or the retailer, then the IND AS 104 shall not be applicable in this case. And number two, employer assets and the liabilities under the employee benefit plans. Employer assets and employer liabilities under the employee benefit plans. In this case, IND AS 104 shall not be applicable. And retirement benefit obligation, which is reported by the defined benefit retirement plan, then the provision of IND AS 104 shall not be applicable. Instead, the provision of IND AS 104 shall not be applicable on the product warranty, which is issued by directly by any manufacturer, dealer, or by any retailer, or employer assets and the liabilities under the employee benefit plan and under the retirement benefit obligation, which are reported by the defined benefit retirement plan. And the contractual rights or the contractual obligation that are contingent on the future use of or right to use a non-financial item as well as a lease residual value guaranteed embedded in the financial lease. Instead, IND AS 104 shall not be applicable on the conceptual right and the conceptual agreements that are contingent on the future use or right to use a financial non-financial item as well as a lease residual value which is guarantee embedded in the financial lease. And IND AS 104 shall not be applicable in the case of financial guarantee contracts. The provision of IND AS 104 shall not be applicable in the case of financial guarantee contract unless the issuer has previously assert explicitly that is that it regards such contract as insurance contract and has used the accounting application applicable to the insurance contract, in which case the insurer may elect to apply either IND AS 32 or IND AS 107 and IND AS 109 or this standard to the financial guarantee contract. The issuer may make that election contract by the contract, but the election for such contract is irrevocable. And the provision, the IND AS 104 shall not be applicable on the contingent consideration, the amount of contingent consideration which is payable or which is receivable in the business combination. IND AS 104 shall not be applicable in the case of contingent consideration which is receivable or which is payable in the business combination. And IND AS 104 shall not be applicable in direct insurance contract that the entity hold However, a cedant shall apply this standard to the reinsurance contract that is hold. Is that for easy to the reference, this IND AS describe any entity that issue an insurance contract to the insurer to sorry this IND AS describe any entity that issues an insurance contract as an insurer, whether or not the insurer is regarded as an insurer for the legal or supervisory purpose. The reinsurance contract is the type of insurance contract. Accordingly, all reference in this IND AS to the insurance contract also apply to the reinsurance contract. Is that all the provision which are applicable on the insurance contract as per IND AS 104 shall also be applicable to the reinsurance contracts. Then, in the summarized form, we can say that IND AS 104 shall be applicable on the insurance contract including reinsurance contract, and it is also applicable on the financial instruments that is issued with the discriminatory participation features. And the IND AS shall not be applicable to IND AS 104 shall not be applicable to product warranty and employer's assets and the employer's liabilities under the employee benefit plan and retirement benefit obligations. And it is not applicable on the conceptual right and under the conceptual agreement. It is not applicable on the financial guarantee contracts. It is not applicable on the financial guarantee contract. IND AS 104 is not applicable on contingent consideration which is payable or receivable in a business combination, and it is not applicable in the direct insurance contract. This is the applicability and the non-applicability of IND AS 104. This is the applicability and the non-applicability of IND AS 104. Now we will discuss the recognition and the measurement of insurance contract. Now we will discuss the recognition and the measurement of insurance contract. Temporary exceptions from some other IND AS. There are temporary exemptions from the some other IND AS. IND AS 8 accounting policy change in accounting estimation and the error specify the criteria for an entity in developing to use in developing an accounting policy. If no IND AS apply specifically to an item. However, this IND AS exempt an insurer from applying those criteria to its accounting policies for insurance contract that is issues including related acquisition costs and related tangible assets such as those described in this standard, and reinsurance contract that is hold. Is that IND AS 8 accounting policies change in accounting estimation and the error specify the criteria for the entity to use in developing the accounting policy if no IND AS apply specifically to an item. However, this IND AS 104 exempt and issuer from applying those criteria of to ind those criteria to its accounting policies for the insurance contract that is issued and the reinsurance contract that is holds. Nevertheless, this IND AS does not exempt an issuer from some implication of the criteria in IND AS, specifically an issuer. Is that this IND AS does not exempt an issuer from the some of the implications of the criteria in IND AS, specifically an issuer. Number 1, shall not recognize as a liabilities any provision for the possible future claim if those claims arise from the insurance contract that are not in the existence at the end of reporting period. Is that the an issuer shall not, as per the provision of IND AS 108, an issuer shall not recognize as an liabilities any provision for the specific or possible future claims if those claims which are arise from the insurance contract that are not in the existence at the end of reporting period, and an issuer shall carry out the liabilities accuracy test, adequacy test. Number 3, the issuer shall remove an insurance liabilities, and issuer shall remove the an insurance liabilities from its balance sheet when and only when it is exhausted. Is that when the obligation which is specified in the contract is discharged or cancelled or expired, then the issuer shall remove the insurance liabilities from the its balance sheet, and the issuer shall not offset the reinsurance assets against the reinsurance liabilities. Is that the issuer shall not offset the reinsurance assets against the related insurance liability, or the issuer shall not offset the income or the expenses from reinsurance contract against the expenses or the income from the related insurance contracts. The insurer shall consider whether its reinsurance assets are impaired. He said, nevertheless, this IND AS does not exempt an insurer from some implication of the criteria 108. Specifically, in this case, the insurer shall not recognize the amount of any liabilities, any provision for the possible future claim if those claims are arise under the insurance contract that are not in the existence at the end of reporting period, and the issuer shall not carry out the liability adequacy test, and the insurance shall not remove the insurance shall remove and insurance liabilities from the balance sheet when the obligation which is specified in the contract is discharged, cancelled, or expired. The insurer shall not offset reinsurance assets against the related insurance liabilities or income and expenses from reinsurance contract against the income and expenses from the related insurance contract, and the insurer shall consider whether its reinsurance assets are impaired. Point first is liabilities adequacy test. What is the liability adequacy test? An insurer shall assess at the end of each of the reporting period whether its recognized insurance liability are adequate using the current estimation of the future cash flow under its insurance contract. Is that the liability adequacy test is a test in which the issuer shall assess at the end of the each reporting period whether it recognized insurance liabilities are adequate, and for the purpose of this the insurer will use the current estimations of the future cash flow under the insurance contract. If the assessment show that the carrying amount of insurance liabilities is inadequate in the light of estimated future cash flow, then the entire discrepancy shall be recognized in the profit and loss. In the case of assessment, when the insurer found that the carrying amount of the insurance liabilities is inadequate in the light of estimated future cash flow, then the entire discrepancy shall be recognized in the profit and loss. If an insurer apply a liability adequacy test that meet specified minimum requirement, then this IND AS this IND AS impose no further requirement. The minimum requirement are as follows. If an insurer apply a liability adequacy test that meet the specific minimum requirements, then this IND AS does not impose any further requirement. The minimum requirement which are as follows. Number one, the test considers the test considers current estimate all the conceptual of the contractual cash flows and of related cash flows such as claim handling cost, such as well as cash flow which is resulting from embedded option and guarantees. Is that the test considers the test considers current estimate of all the contractual cash flows and of related cash flow such as claim handling cost as well as cash flow which is resulting from the embedded option and guarantees. If the test shows that the liability is inadequate, then the entire deficiency is recognized in profit and loss account. If if the test show that the amount of the liabilities is inadequate, then the entire amount of deficiency is recognized in the profit and loss. If the issuer accounting policy does not require, if the issuer's accounting policies do not require a liabilities adequacy test that meet the minimum requirement, then the issuer shall, if as per the accounting policy of the issuer which does not require a liabilities adequacy test that meet the minimum criteria or minimum requirement, then then the insurer shall determine the carrying amount of relevant insurance liabilities. Then the insurer shall determine the carrying amount of the relevant insurance liabilities and less the carrying amount of. First, he will determine the carrying amount of the relevant insurance liability and less the carrying amount of number one, any related deferred acquisition cost, less the carrying amount of any related deferred acquisition cost and any related intangible assets such as those which are acquired in a business combination or portfolio transfer. However, related reinsurance assets are not considered because an insurer accounts are when the insurer accounts for them separately. Point B is determined. The insurer will determine whether the amount which is described in A is less than the carrying amount when the insurer determine whether the amount which is described in A is less than the carrying amount that would be required if the relevant insurance liability were within the scope of IND AS 37. The insurer will determine whether the amount which is described in point A is less than the carrying amount that would be required if the relevant insurance liabilities were within the scope of IND AS 37. If it is less, then the insurer shall recognize the differences in the profit and loss account. Is that if there is any deficiency, then such a deficiency should be recognized in the statement of profit and loss and decrease the carrying amount of the related deferred acquisition cost or related intangible assets or increase the carrying amount of the related relevant insurance liabilities. Impairment of reinsurance assets. Now we will discuss the impairment of reinsurance assets. So, if a cedent's reinsurance assets is impaired, if there is any reinsurance asset which is impaired, then the cedent shall recover. Then the cedent shall reduce its carrying amount accordingly and recognize that impairment loss in the profit and loss account. Is that if the reinsurance assets is impaired, then The cedent shall recognize such impairment loss in the profit and loss. A reinsurance assets is impaired if and only if a reinsurance assets is impaired if and only if there is objective evidence as a result of an event that that occurred after initial recognition of the reinsurance assets, and the cedant may not receive all the amount which is due to it under the terms of contract. Is that the amount of impaired, the amount of reinsurance assets, a reinsurance assets is impaired only when if there is the objective evidence as the result of an event that occurred after the initial recognition of the reinsured assets, that the cedant may not receive all the information or does not receive all amount which is due to the which is due to it under the terms of contract, and that event has the reliably miserable impact on the amount that the cedant will receive from the reinsurer. If these conditions are satisfied, then the reinsurance assets is impaired. Otherwise, the reinsurance assets will not be impaired. Change in accounting policy. Now we will discuss the changes in accounting policy as per the IND AS 104. Is that if there is any change in accounting policy, then what will be the treatment? As per IND AS 104, an insurer may change in the accounting policy for the insurance contractor. Is that if there is any insurer who want to change in the accounting policies, then the issuer can change, and such changes shall be made only if then such changes shall be made only if the change makes the financial statement more relevant to the economic decision making needs to the users, and not and no less reliable, or more reliable and no less relevant to those needs. An issuer shall judge the relevance and the reliability by the criteria in India's 8. Is that if there is any issuer who want to change any of the accounting policy for the insurance contract, then the issuer can change only if due to such changes the financial statement become more relevant to the economic decision making for the users, and no more reliable, or more reliable and not less relevant to those needs. For the purpose of this, an issuer shall judge the relevancy and reliability by the criteria of IND AS 8. Is that by the IND AS 8, the issuer will determine and judge the relevancy and reliability. Insurance contract which is acquired in the business combination or the portfolio transfer. When there is any insurance contract which are acquired in the business combination or in the portfolio transfer, then to comply with IND AS 103, then the issuer will comply the IND AS 103. The issuer shall at the date of acquisition measure the fair value of the insurance liability which is assumed and insurance asset which is acquired in the business combination. Is that as per the IND AS 103 business combination, and issuer shall at the acquisition date measure the fair value measure the fair value of the insurance liabilities, which is assumed, and insurance asset, which is acquired in the business combination. However, an issuer is permitted but not required to use an expanded presentation that splits the fair value of acquired insurance contracts into two components. Instead, an insurer is permitted but not required to use the expanded presentation that splits the fair value of the acquired insurance contract into two components. Number one is a liability, which is measured in the accordance with insurer accounting policies for insurance contract that is issued, and the next component is an intangible assets, which is representing the differences between the fair value of the conceptual insurance rights which is acquired and insurance obligation assumed, and the amount which is described in paragraph or point A. The subsequent measurement of this asset shall be consistent with the measurement of related insurance liabilities. Is that there are two components. Number one is the liabilities measured in the accordance with the insurer accounting policy for insurance contract that it issue, and an intangible assets representing the differences between the fair value of the conceptual insurance rights which are acquired and insurance obligation which are assumed, and the amount which is described A. In A. The subsequent measurement of their assets shall be consistent with the measurement of the related insurance liabilities. And issuer acquiring a portfolio of insurance contracts may use the expanded presentation which is described in our paragraph. The issuer acquisition of a portfolio of insurance contract may use the expanded presentation which is described above. The intangible assets which is described in the above paragraph are excluded from the scope of IND AS 38 and IND AS 36 impairment of assets. Is that the intangible assets which are described in the above paragraph are excluded from the scope of IND AS 36 or IND AS 38. However, IND AS 38 and IND AS 36 apply to the customer list and customer relationship, which is reflecting the explanation, which is reflecting the expectations of future contract that are not the part of conceptual insurance obligation that exist at the time of business combination or portfolio transfer. Is that IND AS 38 and the IND AS 36 is applicable on the customer list and customer relationship, reflecting the expectations of a future contract that are not the part of conceptual insurance right and the conceptual insurance obligation that are existed at the time of business combination or the portfolio transfer. Disclosure. What are the disclosure requirement as per the IND AS 104? Now we will discuss the disclosure requirement as per the IND AS 104. Number one, explanation of recognized amount. Disclosure in the respect of recognized amount. And issuer shall disclose the information that identify and explain the amount in its financial statement which is arising from the insurance contract. Is that the insurer shall disclose the information that identify, and he will also explain the amount in the financial statement, the amount which is arising from the insurance contract. To comply with the above disclosure paragraph, the insurer shall disclose is that he will disclose the amount of insurance contract. For the purpose of this, the issuer shall disclose the following points. Number one, the issuer shall disclose its accounting policy for the insurance contract and the related assets, liabilities, income, and the expenses. Is that the issuer shall disclose its accounting policy for the insurance contract, and he will also disclose all the related assets, liabilities, income, and the expenses. Point B, the issuer shall disclose the recognized assets and the recognized liabilities, income, and the expenses which is arising from the insurance contract. Furthermore, if the insurer is a cedent, then it will disclose number one, the amount of any gain or the amount of loss which is recognized in the profit and loss on buying the reinsurance contract. If the cedent defers or defers and amortize the gain or the loss which is arising on buying the reinsurance, then the amortization for the period and the amount which is remaining is that any of the unamortized amount at the beginning and the end of the period is to be disclosed by the insurer. Is that the insurer will disclose in the case of accident, number one, the amount of gain or the amount of loss which is recognized in the profit and loss account on buying the reinsurance, and if the accident defers and amortize the gain or loss which is arising on buying the reinsurance, then the amortization for the period and the unamortized amount at the beginning or at the end of the reporting period shall be disclosed by the reinsurer, by the insurer, and the insurer will also disclose the process which is used by the insurer to determine the assumption that have the greatest effect on the measurement of the recognized amount, which is described in point B. When practicable, the insurer shall also give qualified disclosure of these assumptions, and the insurer will also disclose the effect of change in assumption which is used to measure insurance assets and insurance liability, and showing separately the effect of each change that have a material effect on the financial assets, on the financial statement, and the issuer shall also and the insurer shall also disclose a reconciliations of changes in insurance liabilities, reinsurance assets, and if any related deferred acquisition cost. Is that all these following disclosure are to be made by the insurer. Nature and extent of risk which is arising from insurance contract, is that what are the disclosure requirement in the respect of nature and extent of risk which is arising from the insurance contract, and insurers shall disclose the information that are the very much useful for the user of the financial statement, so that the user of the financial statement can evaluate the nature and the extent of the risk which is arising from the insurance contracts. To comply with the above paragraph, the insurer shall disclose is that The insurer shall disclose the following point so that the user of the financial statement can obtain the relevant information. These points are: number one, its objective, policy, and the process for managing risk which is arising from the insurance contract, and the method which is used to manage those risks. Is that the insurer, the issuer, the insurer shall disclose its objectives, policy, processes for managing the risk which is arising from the insurance contract, and he will also disclose the method which are used to manage their risk. Number two, the insurer shall disclose the information about the insurance risk, including information about the insurer shall include the and disclose the information about the insurance risk both before and after the risk mitigation by reinsurance, and including the information about the sensitivity of insurance risk and concentrations of insurance risk, including a description of how the management determine concentration and a description of the shared characteristics that identify each concentration, and an actual claim and the amount of actual claim which is compared with the previous estimations, and the actual amount of claim which is compared with the previous estimations. Point is, the insurer will also disclose the information about the credit risk, liquidity risk, and the market risk that would recognize if the insurer if the insurance contract were within the scope of IND AS 107. However, the insurer need not provide the maturity analysis requirement. However, the insurer need not be required to provide the maturity analysis requirement by paragraph A and paragraph B of IND AS 107 if it discloses all the information about the estimated timing of net cash outflow which is resulting from an analysis by estimated timing of the amount which is recognized in balance sheet. And however, if the insurer use an alternative method, if the insurer use an alternative method to manage sensitivity to the market condition, such as an embedded value analysis, then it may use that sensitivity analysis to meet the requirement of IND AS 107. Such an insurer shall also provide the disclosure requirement by the IND AS 107, and the insurer shall also disclose the information about the exposure to the market risk which is arising from embedded derivatives which is contained in the host insurance contract. If the insurer is not required to and does not disclose or does not measure the embedded derivatives at the fair value, then to comply with paragraph C1 is that sensitivity of insurance risk. Sensitivity of insurance risk, and insurers shall disclose either A or B as follows. To comply with the paragraph C.1 sensitive risk, the insurer shall disclose either A or B as follows. A is a sensitivity analysis shall show how profit and loss and the equity would have been affected if changes in the relevant risk variable that were reasonably possible at the end of reporting period had occurred, and the method and assumption which are used in preparing the sensitivity analysis, and if there is any changes for the previous period in the method and assumptions used. However, if an issuer However, if an insurer use an alternative method to manage the sensitivity to the market condition, such as an embedded value analysis, then it may meet this requirement by disclosing that alternative sensitivity analysis, and disclose this requirement by paragraph 41 of IND AS 107. And the issuer shall also disclose the quantitative information about the sensitivity and information about those terms and conditions of the insurance contracts that have a material effect on the amount, timing, and uncertainty of the insurer future cash flow. Is that for the purpose of point C1, the insurance shall disclose either A or B. In A, it will show the sensitivity analysis that show profit and loss and the entity would have been affected in the change of relevant risk variable that were reasonably possible at the end of reporting period. And it will also disclose the quantitative information about the sensitivity and the information about the terms and conditions of the insurance contract that that has a material effect on the amount, timing, and uncertainty of the issuer's future cash flow. This is our IND AS 104, in which we have covered all the main topics, just like objective of IND AS, scope of IND AS, and disclosure requirement by the IND AS and insurance contract, and all other important points of IND AS 104. Thank you for watching this video.